It is important for anybody who starts investing. There's a reason we tell you this is long-term money that you can let sit out there for 5 to 7 years, is because even in normal markets, we're doing the 5 biggest drops. But you think about the intra-year changes that we see, and I don't know if anybody's ever shared this with you, but if you look at it, we have a graph up on the screen, and for my podcast listeners, it is very common that every year, including the good years, you're going to see intra-year changes or drops of around 14%. People don't know that. They just assume that when we talk about an annual rate of return of 8%, 9%, it's going to come in those nice little prefabricated cubes. No, there's going to be a lot of gut-wrenching emotions that you better be prepared. It's a feature of this wealth building process, but don't get caught up in the emotional side of this.
I think people don't recognize that when you hear years like 2003 where the market made almost 30%, they don't recognize that inside of that year, the market was down 14%, or in 2009, when the market makes almost 25%, inside of that year, the market was down 28%. Volatility and downturns and the market moving up and down is normal. That's why you want to make sure that you don't make rapid decisions when things get uncomfortable, because the worst thing that you can do is try to get out of the bottom when it's going to turn very, very quickly. And I think these next couple severe bear markets show us that, because this is one, Brian, you remember all too well, the 2000 to 2002 dot-com bubble bursting.
This is what's amazing to me, is that these last 3 that we go, I actually was managing money through all 3 of these. And the dot-com bubble, just to kind of set the stage for everybody, and once again, everybody's chasing the hot tot and the trend. If you look at what the headline was on this, the year .com turned into .bomb. And I did live through this, and this is where it didn't matter if you were doing pet food, if you're doing grocery stores, if you just put .com at the end, money was just being thrown out there after people, because once again, the human factor is that we pile into things thinking that we're going to get into the latest, greatest trend, and it was devastating financially to a lot of folks.
And so what ended up causing this was exactly that, this massive speculation on unprofitable companies. Oh, the opportunity looked so exciting, so amazing, so incredible that the fundamental numbers did not actually justify the valuations these companies were seeing. And what that ultimately led to was overvaluation, companies being listed for way more than they were worth, and herd behavior. You would go to the office Christmas party or to the family reunion, and all of a sudden you hear somebody telling you about, oh, this latest, greatest, amazing, high-flying stock they made all this money on. And so naturally you decide, okay, I got to pile in. And this FOMO-driven investing, this idea that if I'm not in, then I'm going to miss out, led to the market being unbelievably frothy and even irrationally exuberant.
Well, I think it's something, and we'll get to what the key takeaway is, but this is something just for you to internalize and think about, is that a lot of people, when we have disruptive new technology, you have to realize that this disruptive technology is going to take a lot and turn it into a few key players. So to have those few key players that end up coming out top of the heap at the end, you're going to see lots of destruction in the wake of that. So let's actually look at the actual numbers.
Yeah, from this drop, from the dot-com bubble bursting, if you look at the S&P 500, it actually dropped 49%. It cut in half over this time period.
Yeah, I mean, and this is widespread wealth destruction. We had, you think about this, the recession of 2001 kicked in. You also, this is the start of the lost decade. Now I want to give you guys the context of somebody who was actually managing money through this, is that if you were a professionally managed portfolio with diversification that was goals-based in your risk profile, you actually did really good. This was a great time to be a financial advisor, because I remember how in this period, diversification actually got a lot of people through this and actually come out even better.
Yeah, if you are someone and you're going through this downturn and you're going through this type of scary market, the things that have always been sound continue to be sound, and actually continue to be even more sound. Things like diversifying your portfolio, not having everything in one basket. Things like dollar cost averaging. Yes, the market from the peak to the trough dropped 49%, but if you were buying every month or every quarter or putting your money to work every year, you were actually capitalizing on that decline. And if you have a long-term horizon, if you can zoom out and say, okay, yes, the market is down right now, my portfolio is down, I have some losses on paper, but my timeline is 10, 15, 20, 25, 30 years out into the future. If you can have that perspective, those tools, those keys can allow you to be a successful investor even when these market environments present themselves. So what's the big takeaway we have from the dot-com bubble bursting?
Hype is not a business model.
That's exactly right.
And that's like I said, a lot of destruction is going to be created. And I think a lot of people feel like they have to go scramble in and try to pick the next big winners. But it is worth remembering that 90% of actually fund managers who are doing this, getting paid professionally to go pick the next latest and greatest thing, underperform just the index. And that's over a 15-year time frame. So guys, I'm telling you, innovation is going to create lots of opportunities for you to make money off of, but there's also going to be lots of destruction in its wake. So quit trying to pick the winners yourself and just buy the market itself, and I think you'll be rewarded in the long term in a much better way.
Oftentimes, it's a more prudent investing strategy to just be the market than to try to beat the market. And the dot-com bubble sort of underlined that to be true.